Hey, hello, this is Jim Harvey, president of Opus 111 Group, and today's Your Money Week, I want to talk about what's on everybody's mind, which is the Russian invasion of Kuwait. What are the economic and market impacts as we watch this unfold? Obviously, the invasion is top of mind with everyone in terms of the economic and market impacts, but we already had a market that was already volatile due to lingering effects of COVID, increased inflation, an increasingly hawkish Federal Reserve, which means that they were going to raise rates, and a rotation from large cap growth tech stocks like Tesla and Amazon, Google, et cetera, to cyclicals and large cap value. The real question is then, what do you do? And we're going to talk a little bit about that. But let's talk about the political impacts first of this invasion. I mean, first of all, I don't think anybody really thought that Ukraine would get the kind of amazing support from other European countries, particularly military support. I think Germany, prior to this invasion, were sending like 5,000 helmets to the Ukraine, but now they're really stepping up in terms of missiles. The internal and worldwide protests that we're seeing are stunning. And while Ukraine is fighting valiantly, I don't think there's any way that Putin can stay, can be held off. I mean, the Russians, if they want to take over Ukraine, are going to take over Ukraine. But in the process, Putin has managed to alienate and unify Europe against him. The sanctions that the U.S. and Western Europe are putting are aggressive. Oligarchs are getting hit hard. Some interesting, developments. Germany is now establishing gas reserves, which they've never done before. Obviously concerned about disruption in gas supply. They're also, for the first time ever, or certainly in recent history, increasing their military budget by 2%. Finland, which has, of course, been fighting with the Russians for years, just ordered 64 F-35s at $500 million each. That'll be good news for Boeing here in Washington State. There's a real question about, will Putin invade NATO countries? We heard earlier today General Petraeus, who basically said that what Putin has done is the best thing that's happened to NATO since the Cold War. Obama and Trump tried to get NATO to step up, but Putin basically has galvanized NATO. So Putin has managed to make Russia a pariah, which is something that you have to pay attention to. The economic impacts are probably less profound than the immediate market impacts. The history shows that geopolitical crises like these don't really have lasting impacts. Russian energy exports, certainly there's going to be a rise in global energy prices, but let's keep in mind that Russia is ranked the 11th largest economy in the world. It's about 1/20th the size of the United States and 1/15th the size of China. To give it a sense of perspective, the Russian economy is basically the size of the economy of Orange County, California. Now, in Europe, Baltic states and Poland will suffer for sure. Whether Putin physically invades the Baltic states and Poland and Romania, there's no question that their cyber attacks have been going on and will continue. The immediate impact on Russia is pretty profound. Their stock market and the ruble are down 50%. And according to the chief equity strategist of JP Morgan, Russia and Ukraine is a low earnings risk for U.S. corporations, with just 0.6% of disclosed revenue for companies in the Russell 1000 coming from Russia. It added stress to a market that was already skittish and looking to correct. International equities will be affected short term, but long term, many people think, and I'm one of them, that they will outperform U.S. stocks over the next 20 years. U.S. Treasury bond dropped sharply as investors fled to the safe haven of U.S. securities. And that will continue to be the case as long as major foreign governments, sovereign debt funds, and that kind of thing have negative yields. But these are mostly short-term impacts, and will have minimal long-term impacts. There's a chart here that you can see that basically shows you that if you look at wartime returns 4 months prior to the war's beginning and through the end of the war, and then you look at the performance of the various parts of the U.S. stock market, large cap, small cap, et cetera, you will find that the market has done rather well, even during war. And then the far right column where you're looking at the inflation rates, they vary from as low as 3% to as high as 5.2 during World War II. And today's discussions about inflation being 3%, that's a major thing. So you would expect during wartime that the stock market would be increasingly volatile. It's just not the case. In the past, you might think, and we kind of believe this, that the U.S. economy is more dependent on capital goods and natural resources. So there might have been more of an impact on economic growth. But in today's knowledge-based economy, I think that impact is significantly lessened. Bonds generally underperform due to higher inflation in wartime. As governments borrow more, yields are up and prices go down. And there's no question that this invasion has basically produced higher energy costs, food prices on a short-term basis. But compared to the disruption that we faced 2 years ago and since with COVID, I think that was far worse than the impact of this particular aggression on the part of Vladimir Putin. Long term, the stock market is basically trades on GDP growth, earnings, valuation, interest rates. Those are the things that drive long-term results. Here's another chart that pretty much shows you that going back to 1975, that no matter what the violent war situation is globally, that the S&P has powered through it. Here's another chart that I think is pretty interesting, the 10 worst days for the S&P between 1980 and 2020. And what you'll see is that the 1 day percentage drop and how many days it needed to reach the next high. But the returns after 1 year, 3 year, and 5 years are pretty solid. So, there's that to consider. So, what do we do? Let's first talk about the market volatility year to date and where we are. Like I mentioned, they were already volatile due to lingering effects of COVID, which I think is abating, increased inflation and the Fed, and the rotation from large tech stocks to cyclicals and large cap value. Year to date, as of Friday, the S&P was down 10.2%, the NASDAQ was down 15%, the Russell 2000 was down 10.8%. Oil, however, was up 25%. Treasuries are up 22% because of all the people sending money into the most secure liquid investment on the planet, which is the 10-year Treasury. And gold is up 10%. So with that in mind, how do we handle things, and what kinds of things might you think about for your own portfolios? First of all, you should have a plan, and you should have an overall allocation. And we really pound our clients not to react to headlines. If your personal financial situation has changed or your risk parameters have changed, then you either need to talk to us if you're a client or someone else who's a professional. Higher inflation is going to be more persistent. We have always maintained an exposure with our clients to commodities, managed futures, and real estate. But we may end up increasing allocations to that part of the investment world. With rising interest rates, I think you've got dividend-paying stocks are a good place to put money as corporations pass along the higher costs to consumers. Also selling any long-term bonds and waiting for buying opportunity. I think in terms of the rotation from growth to value, if you have a high concentration of large cap growth stocks and the ones that everybody loves, probably time to trim those back, not sell them, but trim them, and look for large cap value cyclicals, dividend growth stocks, and the like. And then finally, international equities, which have not participated in the boom market that we've seen since the credit crisis in the United States and worldwide between 2007 and 2009, they, I think, are going to do better. We've talked about Fed hikes. I think originally, prior to 2 weeks ago, we were probably talking about 5, 6 Fed hikes. Now we're thinking it might be a little lower because I think the Fed and also European Central Bank and Japan's central bank are going to be a little less likely to be as aggressive because inflation and growth prospects are going to be affected. But if you look at this particular chart, it talks about the last 5 Fed rate hikes and what the average return of the S&P was the 12 months before, 6 months before the initial hike, 6 months after, 12 months after, et cetera. And as you can see, it looks pretty darn good. Now, one of the things that we really don't pay attention to enough is I call it concentration risk in US stock market indices. The S&P 500, the 5 largest stocks in terms of market capitalization and what percentage those stocks represented the overall the index's market cap is the highest in history. It now represents 23% of the index total market cap. The NASDAQ 100 is higher still. They represent 41% of the market cap. What's the problem with that? Well, first of all, that kind of a concentration can really distort the performance of an index. It increases the volatility of an index. And then basically you have to depend on the dispassionate decision-making of all of your friends and neighbors who invest in passive index vehicles like index mutual funds and ETFs. So it's very much, as I like to say, as a red hair stepchild. When it's good, it's really, really good. But when it's bad, it's been really, really bad, except that people haven't remembered that much because the last time it was really bad was in 2007 and 9. But if you invest in the index return, you're going to get the index risk. Here's a chart that shows you the top 5 names percentage in the S&P 500 from 1999 to 2022. And you can see down below the 5 stocks in 1999 were Microsoft, General Electric, Costco, Walmart, and ExxonMobil. Today it's Apple, Microsoft, Google, Amazon, and Tesla. I mean, there's no value stocks there. And the highest it had ever been before was 17%, and now it's 23%. That's, a source of concern. NASDAQ 100, it's very similar. In 1999, it was Microsoft, Qualcomm, Cisco, Intel, and Oracle. And now it's Apple, Microsoft, Google, Amazon, and Facebook. So again, it is very high, although you'll notice that it has been a higher percentage of that index on a more profound basis than the S&P 500. And then the last thing that I wanted to talk to you about is the distortion effect of having such a concentrated 5 stocks and what it can do to index returns. So let's go back to 2020, the first quarter. That was just as COVID hit. The market bottomed on March 23rd of 2020. The S&P 500 for that first quarter, just a couple of weeks later as it closed, was down 19.3%. But the top 5 stocks were only down 16. The next 495 stocks were down 27%. So 5 stocks brought the entire index's return down from 27% to down 19. I mean, that's an enormous effect that 5 companies has. So I will leave you with one last chart that we use, and unfortunately, basically when the market drops 57%, you need 123% return to go back up to par. And if it only drops 15, you only need 18. And when I do lectures at Stanford, I typically use this, and you see the red hour first, down 57, down 15, and then the next one is the green hour going back up. And I say, okay, well, can you get 123% return without taking undue amounts of risk? And all of the people in the audience will go, well, no, you can't. And then I said, well, and then the second part, if does the market regularly produce 18% return? And most people shake their head and say no. And the answer is they're right about the first and wrong about the second, because the market regularly produces returns of in excess of 20%. But these numbers weren't drawn randomly. That 57% drop represented the drop in the index between October of 2007 and the bottom of the market on March 9th of 2009. So people have basically just told you and me that the S&P index by itself is too risky. And I kind of agree. And during our, that period of time, most of our clients had drops of less than 15%. So they didn't need as much upside to get back to par. And, the S&P took 4.5 years to get back up to break even. So just keeping things in perspective, I hope this has been valuable. Obviously, there's a lot of information out there. If you're not working with a professional, find one, in my opinion. And if you want to learn more about our firm and some of our perspectives, see some of our blogs and podcasts like this one, go to our website, opus111group.com, go to the Learn Center, and you will find a whole bunch of really good information that you might be able to use. Anyway, this is Jim Harvey, president of Opus 111 Group. Thank you very much for your time. Hope this has been useful, and make it a great day.